Most investors rely on only one type of compounding. It works, but it's slow. The truth is, there are 4 separate engines that can multiply your results, not just add to them. And here's the surprising part. The third one can start showing results in as little as a week. In this video, we'll break down all 4: dividend reinvestment, time in the market, monthly contributions, and dividend growth, and show how using them together accelerates wealth. Quick question for you. Which of these engines are you already using? Drop it in the comments. Let's start with the first engine, one that sounds boring yet quietly builds millionaires. The first compounding engine is dividend reinvestment, often called DRIP. At a glance, it doesn't seem exciting. In fact, many people overlook it, assuming dividends are just small cash payouts. But when reinvested, those dividends quietly become one of the most reliable drivers of long-term wealth. Instead of sitting idle or being spent, they buy more shares, and those new shares start paying dividends too. Over time, that cycle builds momentum, creating growth that feels invisible at the start, but becomes massive decades later. Here's why this is so important. Many investors treat dividends like extra pocket money. They take the cash, spend it, or let it sit in an account. The missed opportunity? Those payouts never get the chance to generate more income. Think of dividends as seeds. Spend them, and they're gone forever. Replant them, and they grow into trees that produce even more seeds season after season. That single habit is what separates portfolios stuck in neutral from those that multiply naturally. To see this in action, let's look at a real example. Alex, a nurse in her late 20s, started with $100,000. She split it evenly, $50,000 into a reliable dividend fund and $50,000 into a real estate company known for steady monthly payouts. The fund offered about a 4% yield and the real estate company around 6%. She set everything to automatically reinvest. At first, the growth looked unremarkable. A few extra shares here, a slightly larger payout there, but compounding works quietly. After 10 years, her original $100,000 had turned into roughly $230,000, all without adding a single new dollar. At 20 years, the total reached over $1 million. By 30 years, it grew to about $3.7 million. These aren't guaranteed results, but they illustrate how reinvested dividends transform small checks into life-changing sums. The numbers back this up at the market level too. Long-term studies show that reinvested dividends have contributed nearly 1/3 of the S&P 500's total returns historically. Put another way, if you skipped reinvesting dividends, you would have missed out on 1/3 of the market's wealth creation. That's not a minor detail, it's the difference between a portfolio that creeps along and one that compounds at full strength. So how do you apply this? The action step is simple. Log into your brokerage account and enable automatic dividend reinvestment, DRIP, in your settings. That's it. From then on, every payout buys more stock or fund units. Those extra units pay more dividends, and the loop continues without you lifting a finger. It's a one-time decision that sets your wealth to build in the background while you focus on your life. One way to picture this is as a snowball rolling down a hill. In the beginning, it seems small and unimpressive. But with each turn, it picks up more snow, grows heavier, and rolls faster. That's exactly what reinvestment does. The first few dollars may not look like much, but over years and decades, those reinvested dividends add weight and speed to your portfolio's growth. The earlier you start, the bigger and faster that snowball becomes. The key takeaway is simple. Dividends should never be treated as loose change. They are seeds of future wealth. Reinvest them and you activate a financial engine that compounds automatically, scaling over years into something much larger than it first appears. Skip them and you stay reliant only on market gains. But there's an important point. Reinvested dividends build gradually. You don't feel their true impact until years have passed. That brings us to the next engine, one that depends not on what you do today, but on letting time itself work in your favor. The second engine is what I call the silent force of investing, time itself. It's not loud or flashy, but it rewards the patient in ways nothing else can. In the beginning, the growth feels invisible, sometimes even frustrating, but that's exactly why it's so powerful. Imagine a bamboo plant. For years, nothing seems to happen above the soil, and then one season it shoots sky high almost overnight. That's what time in the market looks like. Long stretches of quiet, followed by growth that seems to appear all at once. The early years are where most people stumble. They make contributions, check their balance, and think the progress looks too slow. Some lose patience and cash out. What they don't realize is that compounding builds quietly before it becomes visible. Shares accumulate, dividends reinvest, and price growth slowly compounds. What feels stagnant is actually the foundation for much larger growth later. To illustrate this, let's look at a hypothetical investor. Ben, a math teacher in his 30s. He started with $70,000 in a broad market index fund and $30,000 in a single fast-growing company. The numbers here are just examples, not guarantees, but they show how scale builds. The index fund averaged about 13% per year, while the single company returned closer to 30% per year. After 10 years, Ben's patience didn't look like much to his friends. Steady growth, but nothing spectacular. But by year 20, the index fund had grown to roughly $770,000, while the company's stock had exploded to about $5.5 million. And by year 30, the combined total had reached around $58 million. Now again, that's a case study meant to illustrate compounding, not a promise of what you should expect. Markets vary, returns aren't predictable, and most investments won't achieve those specific results. But the point is clear. Time magnifies outcomes in a way that nothing else does. This illustration shows compounding scale, not guaranteed annual returns. The catch is that you only unlock this power if you stay invested. Trying to time the market or jumping in and out often means missing the very days and years when the biggest growth happens. Research shows that losing even a few of the market's best days drastically reduces long-term returns. That's why the best simple directive is this: choose good, diversified assets, then sit tight. It's not about predicting short-term moves. It's about giving time the chance to do its work without interruption. You might be tempted to compare this approach to chasing hot tips, short-term trades, or trendy stocks. But none of those can match the long-term effect of staying put for years or decades. Even starting at the wrong moment often turns out fine if you remain invested. The longer you hold positions, the more chances compounding has to multiply your wealth. Think of time as the fertilizer of wealth. It may look like nothing is happening, but below the surface, growth is layering on itself year after year. Each decade adds not just another set of returns, but another layer of acceleration. That's why this engine remains invisible until, suddenly, it's undeniable. The takeaway is simple. You don't need to find the next big stock or outguess the market. You need to endure long enough for compounding to reveal its true power. Most people underestimate the effect that decades can have, and that's where the largest gains actually live. Patience is what unlocks this engine, but not every form of compounding forces you to wait that long to see something happen. In fact, there's another engine ahead that can show visible results in just a matter of days. The third engine is dollar cost averaging, an approach where you commit to adding consistent contributions into your portfolio. Unlike other engines that ask you to wait years before you notice results, this one shows immediate movement. The difference is visible as soon as your first contribution posts. Within a week, your balance updates, reflecting the new purchase of shares. That early signal isn't outsized returns, it's simply ownership increasing right away, and that visible progress helps keep you consistent. Here's how it works. Instead of trying to pick the perfect moment to drop in a large lump sum, You spread contributions evenly across time, say weekly or monthly. Each contribution buys more shares when prices dip and fewer when they rise. Over time, this smooths out your purchase price and removes the pressure of market timing. Volatility, which usually feels like risk, becomes your advantage. Every downturn effectively turns into a buying opportunity without you needing to second guess. This matters because many investors wait too long, assuming they need a huge balance to begin. They hold off, hoping to save a lump sum, only to miss years where compounding could already be ticking away. Dollar cost averaging flips that around. You start with what you have, then add steady contributions over time. Those modest, repeating deposits often build a larger position than a lump sum placed at an unlucky market high. The principle is summed up simply: small, regular actions beat perfect timing. To see this in action, consider Clara. She began with $60,000 in a dividend-focused fund, plus another $40,000 in a well-known household brand. On top of that, she added $1,000 every month, no matter what the market was doing. From week one, she could see the effect. Her balance increased the moment her contribution settled, and new shares appeared in her account. Even when the market dipped, instead of panicking, she viewed it as buying more at a discount. That pattern kept repeating, building her ownership relentlessly. Now, what did all that consistency add up to? Based on the example, after 10 years, Clara's contributions had grown to show a meaningful boost, roughly $79,000, more than what she had deposited. By year 20, the total reached nearly $2 million. Extending further, year 30 brought her balance close to $4.5 million. Remember, these are results from this specific case study, not guaranteed returns. But they highlight the effect of steady deposits working alongside compounding. Market swings turned from a source of anxiety into a source of gain because every dip gave her extra shares waiting for recovery. This engine also builds discipline. By sticking to a fixed contribution schedule, you avoid letting fear push you out during declines or greed lure you in only at highs. Each month the system makes the decision for you. That consistency is what compounds wealth over decades more reliably than chasing perfect timing ever could. The practical step here is straightforward. Automate monthly contributions directly into your brokerage or retirement account. Set it once and let it run in the background. To keep yourself on track, add a calendar reminder to check that automation stays active. And if you're eligible, put those contributions into a tax-advantaged account, like a Roth IRA in the US or a TFSA in Canada, for an extra layer of efficiency that accelerates results. The key takeaway: dollar cost averaging isn't about quick riches. It's about creating a structure where your portfolio grows a little stronger every time you add it. You see evidence immediately, and more importantly, you know that every month brings you closer to long-term wealth. But what happens when the investments you're buying not only grow in value, but also pay you more each year along the way? That introduces an entirely different dynamic, one where the flow coming back into your account keeps increasing even when markets take a hit. What if the cash flow from your investments didn't stay flat, but actually rose year after year? That's the unique role of dividend growth investing. Instead of chasing the highest yield you can find, the focus here is on companies with long records of raising their dividends steadily. Those raises may feel modest at first, yet they create a rising stream of income that compounds over time. Unlike high static yields, which can vanish when companies cut payouts, rising dividends provide a way to grow cash flow without selling shares, while also helping you keep pace with inflation. Let's look at a clear example. Dylan allocated $60,000 into an ETF made up of companies recognized for consistently increasing their dividends, and $40,000 into a well-known technology company with a similar track record. The important detail here is that he never reinvested those payouts. He simply let the dividend income collect in cash. During the first few years, those payments hardly stood out. But by year 10, something shifted. The ETF had doubled in value, the tech stock had quadrupled, and his annual income from dividends reached about $8,500. What started as a trickle had become a noticeable stream. By year 20, the results were even more striking. Dylan's combined portfolio had crossed $5 million in value, and the annual dividend payouts alone were producing around $35,000, enough to serve as a second income stream without selling a single share. And by year 30, his annual dividend income had grown close to $300,000. Again, this is not a promise of returns, but it shows how regularly rising payouts can transform an early investment into a powerful long-term income engine. One of the overlooked strengths of this approach is how it holds up under stress. When markets stumble, many high-yield companies slash their dividends quickly because those payouts aren't sustainable. By contrast, firms with long dividend growth histories often work hard to maintain or raise their payouts even during downturns. Protecting that streak is part of their identity. Of course, this isn't guaranteed. Companies can cut if challenges mount, but a broadly diversified portfolio of dividend growers has historically been far steadier than banking on a small handful of high-yield stocks. The difference changes how you experience investing. Your wealth isn't just measured by an account balance bouncing with market swings. It's also measured by the income those holdings generate and grow over time. That cash flow brings psychological stability. You don't feel forced to sell shares just to cover expenses because your dividends alone are rising year after year. That additional layer of security often makes it easier to remain invested through volatile periods, which is where long-term compounding does its real work. If you want one image to keep in mind, think of it as a river that runs wider every season. At first, the water flow is only a trickle, but each year it grows stronger. Eventually, the current is powerful enough to cover expenses on its own, while the original source continues expanding. That's the essence of dividend growth investing. It compounds not just your account value, but also the income you can draw without eroding the base. The lesson here is clear. Dividend growth investing doesn't only expand wealth, it expands peace of mind by creating a rising source of cash flow that proves durable across markets. And when you consider its effect alongside the other engines we've covered, the picture gets even more compelling. Because while each force is strong on its own, their real power emerges when they all work together. Dividend reinvesting, time in the market, steady contributions, and dividend growth. Together, these four engines accelerate wealth while giving you stability through market swings. They don't just grow your balance, they also create a structure that keeps working quietly in the background. If you want to get started tonight, here are 3 simple steps. Enable DRIP in your brokerage settings, set an automatic monthly contribution you can maintain, and review or add dividend growth funds or ETFs to strengthen long-term income. Subscribe for more practical breakdowns, and leave a comment sharing which engine you plan to activate tonight, and what your biggest obstacle is right now: money, knowledge, or discipline.